Amazing. We are live. But as usual, I'll wait a couple of seconds as people trickle in. But in the meantime, as you join in, please feel free to use the chat, say hello where you're tuning in from. Let's be social. And be sure to switch the message to all attendees, not just the panelists. Otherwise, it's just me and Valentina who are going to see your message. All right. Well, as more people trickle in, we can get started. So hello, everyone, and welcome. Thank you so much for joining us today. So my name is Reda. I'm one of the analysts here at Finimize, and I'm going to be going over an exciting topic called how to become an ISA millionaire. Today is actually the second event of our ISA season event series. So lots of exciting things happening. And it's actually really well timed because there's about 10 days left in the current tax year, which means if you don't already have an ISA, actually there's still a bit of time to open one up and make use of your allowance. It doesn't mean you have to rush and buy anything investments-wise, but there's still some time to open up your ISA and make use of the current tax year allowance before it expires in about 10 days. Now, just some quick housekeeping before I get started. So, like I said, please, as you kind of come in, say hello in the chat, say, where you're tuning in from. Be sure to switch the message to all attendees. Second of all, in terms of format, so I've got a couple of slides and cool graphs for you to see, maybe over the course of the next sort of 20 to 25 minutes, followed by 10 minutes at least of audience Q&A, which takes me to my third and final point. Please use the Q&A box in Zoom down below to put your questions for me. And be sure, if you see a question that you like, be sure to upvote it. That way, when the time comes, I can go through the most upvoted questions first. So in terms of what I'll be covering, so two key things really in today's sort of presentation and session. First of all, I want to provide, a basic overview of what an ISA is and how it works. This will be particularly useful for people who did not attend our webinar yesterday that went over some of the basics. I promise I'll make this quite quick because I really want to save the meat of the presentation for the second part, where I want to go over 7 secrets or tactics, should I say, used by ISA millionaires. And what do I mean by ISA millionaires? So even though ISA or investment saving account has a limit on how much money you can put in every year, some investors out there have managed to grow their ISAs to £1 million. And I'm going to go over some of the key things a lot of them have in common. So without further ado, let's kick off. So first of all, what is an ISA? And actually, maybe I'll turn this question around and let me tell you what an ISA isn't. An ISA, okay, is an investment saving account, and it's not an investment in its own right. So you don't buy an ISA like you would buy a stock or a bond or an ETF or whatever. An ISA is basically just an investment account, and you can think of it as a protective wrapper in which you can shelter your money from taxes. So here's a nice analogy. Think of an ISA as a shark cage, and think of all your money, your savings and investments nicely floating around in the middle of the cage, sheltered off by circling tax sharks. And by tax sharks, I am looking at you, HMRC. So the ISA is basically a little cage protecting your money from the taxman. Okay, so just a wrapper account. And then within the ISA itself, within the account, that's how you buy stocks, bonds, ETFs, investment funds, and you name it. Now, it's important to say that there are different kind of ISAs out there in the UK. So you have a cash ISA, stock and shares ISA, innovative finance, junior, lifetime, etc. But the key thing to bear in mind is that while you can invest across several of them within the same tax year, especially in the next tax year, your £20,000 annual allowance is spread across all of them. So you cannot put more than £20,000 across all your ISAs. That limit applies to all the ISAs, regardless of which one you're looking at. So you do not have 20,000 per ISA, to make that clear. You have 20,000 pounds per year that you can spread across different sort of ISAs. Now, the one I want to really focus on is the stocks and shares ISA. That's because that is the ISA that lets you invest in individual stocks and bonds, in ETFs, in different investment funds, investment trusts, and so on. So basically the bread and butter of your investment portfolio. Now, this is quite important to say, and this is, perhaps my own individual opinion, but I want to basically say that an ISA should not replace your pension plan, but you should really think of it as something that supplements your pension plan. And the reason is that if you are provided with a pension plan by your employer, there are some really good advantages to that. So first of all, you get an upfront tax relief. So let's say you're in the 20% tax bracket, you put £80 into your pension plan, you get an automatic top up of £20 from HMRC. Also, a lot of pension plans out there, provided by employers, provide employer matching to your contributions up to a certain limit. So let's say you put £1,000 in a month, they would basically double it. They will add £1,000 in there as well. So a pension plan should really be your kind of first go-to when trying to think and save for your retirement. And after you've really kind of maximized that, and if you have money left over, then you should think about an ISA, which will supplement your pension plan and really help you also fund your retirement in the future. Now, as I mentioned, there is a £20,000 annual allowance in each tax year in your ISA. So within every tax year, which runs from 6 April to 5 April the following year, that is the tax year. And within a tax year, you are only allowed to put a maximum of £20,000 into your ISA. Contributions are made with post-tax income. So what I mean by that is that the money you put into your ISA is money that has already been taxed. So it could be, employment income that lands in your bank after income tax has been paid, etc. But once you take that money and you put it in the ISA, you pay no tax. You pay zero tax on capital gains, dividend, and interest. Also, you pay no tax to withdraw your money from the ISA. Certain ISA providers may charge a fee for withdrawing your money, but there are no tax implications of doing that. You pay no taxes to withdraw your money. Now, I just want to quantify the tax benefits a little bit. So basically, I'm saying, look, in an ISA, you pay no capital gains, dividend, or interest tax. So how much are you actually saving by doing this? So over here, you can see in this table, the capital gains, dividend, and interest tax rates according to the tax bracket you're in. So in the UK, we have 3 tax brackets depending on your income level. Now, if you look at, for example, capital gains, that can range from 10 to 20%. But the numbers, the percentages become a lot more punishing when you start to look at things like dividend income and interest income. So if you are in the middle tax bracket, so the higher rate, if you're a higher rate taxpayer, basically you have to give up a third of your dividend income and just give it to the tax man when you generate it. If you are getting some interest, you have to give 40% to the tax man. Of course, if you're an ISA investor, you don't have to worry about that because you pay no taxes. This is what's so, amazing about these ISA millionaires is that now that they have $1 million basically in their ISA, if that million is, unrealized capital gains on stocks, etc., once they cash out and sell, they owe no capital gains on any of their profits. Also, if they take that million and they invest it in income stocks and government bonds, for example, and let's say, for the sake of argument, they generate 4% a year in income, that is £40,000 a year in annual income that's completely tax-free. And 4% is not unrealistic. Government bonds currently yield about that much, and you have plenty of stocks with dividend yields of 4% or plus. Had that particular person had their 1 million in a normal account, not an ISA, and they got that 40,000 in dividend and interest income, they would have to give up around a third to a 40% of that and give it to the taxman every single year. So at 40%, that's 16,000. You make 40,000 and you have to give 16,000 to HMRC. Pretty hefty. Now, it's important to note actually that in the coming tax year, so the one that's going to start in about 11 days, the capital gains allowance and the dividend allowance will be cut in half. So what do I mean by that? So the capital gains allowance is currently £6,000. What that means is that the first £6,000 you make in capital gains, you pay no tax on. After 6,000, you start to pay some tax on it. But that is going to be cut in half. And what that basically means that if you have investments in a non-ISA account, so in a normal kind of investment account, you are going to be paying taxes on capital gains and dividends sooner because your allowances are going to be cut in half. If anything, that makes ISAs even more attractive as a tax shelter. So if the tax allowances are coming down, you're going to end up paying more taxes. But obviously, if you have an ISA, you're sheltered from all this tax, and that's going to make ISAs even more attractive in the next tax year, starting in 11 days. So I want to move on now to the second part of the presentation and basically share kind of 7 key steps or 7 secrets of ISA millionaires. You can look at them over here, high level, but I want to kind of go in and I have, just something I want to share in each of these single steps. So without further ado. Step 1 is to start today with what you have. So basically to just get started and to open up an ISA if you don't already have one and put as much money as you can possibly afford. So of course, you need to make sure you're paying your bills, your mortgages, etc. Make sure you have a cash buffer, a safety net. Some people say 3-6 months of monthly expenses, etc. But once you've kind of met these minimum requirements, if you have some excess cash, I really recommend you open up an ISA and put some money into it. And the reason is, and really highlighted by this Chinese proverb that I really like, and it says, the best time to plant a tree was 20 years ago. The second best time is now. And this is really applicable to investing. And the reason that is because of compound interest, which Albert Einstein famously called the eighth wonder of the world. What is compound interest? Compound interest basically makes time your greatest ally when it comes to investing and growing your net worth and your financial wealth. Basically, compound interest is, you start to earn returns on your previous year's returns. So your gains in previous years start to make their own gains. And then in the next year, you make gains on your gains, et cetera, et cetera. And this whole thing goes exponential. So if you look at this chart over here, the blue line assumes how an investment would grow with just simple interest. And then the orange line looks at how an investment would grow, assuming compound interest. And compound interest is more than just an assumption. If you're investing in the stock market and you're reinvesting dividends, etc., you benefit from compounding returns. And now look at the gap between the two lines. This grows and widens exponentially with time. So the key thing here is basically time is your greatest ally. The sooner you start investing, the sooner your money can start working for you, and the sooner you can start to benefit from compounded returns, which makes your investments go exponential, essentially. And I want to highlight that with, just a very simple thought exercise. So assume you invest £10,000 every single year into your ISA. And assume you want to hit that, amazing £1 million goal that, we're talking about in this presentation. Now, picture 4 different investors, one that's only going to invest for 10 years, and then 20 years, 30 years, 40 years, etc. And the thought exercise is, what average annual return will you need based on these assumptions to hit that 1 million figure? Now, if you're investing 10,000 every year and you only have 10 years to invest, you're going to need a 47% average annual return to hit 1 million. Now, I don't know what anyone has told you or promised you, but trying to hit 47% a year is delusional, for the lack of any better word. So even the best hedge funds in the world, the best investors in the world, cannot even dream of such numbers. Now, let's say you have 20 years to invest. So you've, started earlier, essentially. 15%. You might say, okay, that looks a lot more reasonable. 15%, also, to be quite honest, is quite high and quite unrealistic. To give you a quick idea, if you look at a 60-40 portfolio invested in 60% stocks and 40% bonds in the US, that has generated about 9.7% on an annualized basis since 1970. 60/40 portfolio is considered a good benchmark of a simple stock bond portfolio allocation, essentially. Now, I said 9.7%, but also, truth be told, some of the tailwinds that we had, since 1970, with a big fall in bond yields, the advent of the internet, and the productivity growth that we saw with all of that, those factors are not going to repeat over the next sort of 3 decades. So 9.7% is already a pretty high benchmark to think about. Now, let's say you had 30 years to invest. Suddenly, you're looking at a much more reasonable, much more realistic 7% average annual return to hit the 1 million target. And if you had 40 years, then you're talking about quite a conservative 4% average annual return. So the key takeaway here is that the sooner you start investing, the more time you have for your investments to work for you, to benefit from the magic of compounding, which makes things go exponential, and the bigger your investment pot at the end of your time horizon, let's say at retirement, for example. So start today, and start today with what you have. The longer you can make your investments work for you, the bigger the investment pot you're going to have in the future. That sounds amazing. So, okay, let's say you like where you're here and you decide to open an ISA account, and then now what, right? What should I invest in? Well, before you kind of decide what to invest in and how to split your portfolio, it's extremely important to sit down and have a think about your financial goals. What is it that you're trying to achieve exactly? Try to understand your ability to take risk, which therefore dictates what kind of return objective you want with your investments. And then once you have that, you can think about how to split your portfolio across different asset classes so that you can generate and hit the return target that you're after. So here's a very kind of high level framework that I like to think about. So basically, trying to ask yourself or trying to examine 3 different things to try to determine your risk tolerance, which basically is how much risk can I possibly take, which determines your return objective, which determines your asset allocation. Now, many things in reality determine your risk tolerance, which is how much risk am I willing to take with my investing, but I try to simplify it and kind of condense it to three key things: your investment time horizon, your liquidity needs, and your other assets. So investment time horizon is basically how long in years, for example, you have to until you need your money. Essentially, it could be for retirement or whatnot. Basically, the longer your investment time horizon, the more risk you can take, because the more time you have to ride out market volatility, to recover from losses, and to replenish your investment account with future savings. On the other hand, if you have a very short investment time horizon, you cannot take a lot of risk with that. So imagine, for example, you're about to retire next year, and you're going to have to use your ISA account to help fund your retirement. You have an investment time horizon of 1 year. You cannot take much risk with that, because if you take a lot of risk and your portfolio goes down by 50% within that in the next year, which could happen, then suddenly you've really jeopardized your retirement objectives. However, if you have 40 years ahead of you, you can take a lot more risk, because you can ride out market volatility, recover from losses, and you can replenish your portfolio with future savings. Liquidity needs is basically how much cash you need from your portfolio. So again, if you are someone in retirement and you have to constantly withdraw cash from your ISA portfolio to sustain yourself during retirement, you have high liquidity needs. You have a high need in cash. Therefore, you cannot take a lot of risk. Once again, if something bad happens to your portfolio, that's going to impact how much cash you can withdraw every single month. It will impact and jeopardize your retirement. On the other hand, if you are currently young and you have the ability to constantly top up your ISA every single year, you have a much higher kind of much lower liquidity needs, and therefore you can take much higher risk with that. And the third and finally, and kind of intuitively, is the value of your other assets. So if all your savings and your net worth is literally tied to your ISA account, you can't take that much risk with it, because should anything bad happen and you lose a lot of money in your ISA, you've suddenly lost a lot of your net worth. If, on the other hand, you have a well-funded pension plan, you own your house, perhaps you have a collection of fine wine bottles, sitting in your cellar, and you have lots of other kind of assets, then you can take more risk with your ISA portfolio, because should anything happen, you have lots of other assets you can kind of fall back on as a safety net. So once you ask yourself these kind of three things, that will help you determine how much risk you are willing to take on, and that will determine not just willing to take on, your ability to take on risk, because maybe you're willing to take on more risk, but you don't have that much ability based on these three things I discussed. And in that scenario, your ability to take risk should always prevail over your willingness to take risk. Once you determine that, then you determine your return objective, and the two should match. That's because in investing, risk and return go hand in hand. The only way to generate higher returns is to take on more risk. On the other hand, if you can only take a low amount of risk, then you can only aim and strive for a low amount of returns. Risk and return go hand in hand. Once you determine your return objective, then you can set your asset allocation. So if you have a very high return objective because you have a high ability to take risk, then you can start to invest your portfolio in asset classes with our high return, high risk, high return. For example, stocks or emerging market stocks. If, on the other hand, you have a low ability to take risk and therefore you have a low return objective, then you have to set your asset allocation toward safer, lower risk, lower returned asset classes. For example, government bonds, etc. So that's step two. Determine your financial goals. Have a think about your ability to take risk, what kind of returns you should aim for, and that will dictate your asset allocation. Which takes me to my third step, which is build a diversified portfolio. Now, you can think about asset classes. So think stocks, bonds, commodities, crypto, real estate, cash. These are all examples of different asset classes. You can think of them as the high-level building blocks of your portfolio. And asset allocation, like I said before, is a function of your risk tolerance and return objective. Now, what's really important here is the word diversified. And what I really mean by here is don't put all your eggs in one basket. So that means two things. First of all, diversify across different asset classes. So have some stocks, have some bonds, have some commodities, etc. Obviously, how much you put in each depends on your risk tolerance and return objective. You will overweight, the stocks, for example, if you have a high return objective, overweight bonds if you have a low return objective, etc. So diversify across asset classes and diversify within asset classes. So let's say you decide you want to put 60% of your ISA portfolio in stocks. That doesn't mean you should take that 60% and buy 2 stocks with it, right? Because that's not diversified at all. Should anything happen to one of the 2 stocks, you could lose a lot of money. And why is it important to talk about losing a lot of money? Because, and this is a really powerful chart over here, it's because if you suffer from a big loss, the amount of gains in percentage terms that you need to recover from that loss grows exponentially depending on the size of the loss. So what do I mean by that? If you lose 1% or 5% in your ISA portfolio, no biggie. You just need about 1% or 5% respectively to get back to where you were. Now, let's say you lost 50% of your ISA portfolio. It's gone down 50% in value. Suddenly, you need to double the ISA portfolio's value just to recover, just to get back to where you were, to recover from the loss. The 50% loss, now you need 100% gain just to kind of break even and get back to where you were. If you suffer from an 80% loss, as you can see in the graph below, you now need a 400% gain just to break even, just to recover from your loss and get back to where you started. Why is this important within the discussion of diversification? Because the best way you can minimize the chance of a really big loss is to diversify. Hypothetically, if you take all your ISA portfolio and invest it in a single stock, perhaps a risky biotech company that is about to pass a new drug that's going to be a blockbuster. Oops, suddenly the drug is not approved. The share tanks 80%. All your ISAs in that one stock, you suddenly lost 80% of your portfolio. To get back to where you started, you need to find other investments that are going to generate 400% return just to get back to where you started. On the other hand, if you diversify well across asset classes and within asset classes, you lower really significantly lower the chance of experiencing a devastating 40, 50% plus loss. Fourth step, and this should really not even be a secret, it should be a no-brainer, but what did the ISA millionaires do is that they maximize their annual allowance. Now, it's really important to say that the annual allowance expires at the end of the tax year, and any unused amount is permanently lost, and it cannot be rolled over to the following year. So imagine in the current tax year, you have a £20,000 allowance, and you've invested and used up 10,000. You have 10,000 left. When the next tax year comes, you do not get that 10,000 unused up plus the new 20 for a 30. It doesn't work like that. Whatever you used up is completely gone, and that's it. You get a fresh 20,000 pound allowance every single tax year, regardless of how you invested in the previous tax year, regardless of how much of your allowance used up. Now, the allowance has gone up over time. So I think when the ISAs first came out, they were called something different in 1987. I think the allowance was something like 2.7 thousand pounds a year. That has gone up over time. For the following tax year, the next tax year, it's expected to remain at 20,000. It's important to say that in the future, the allowance could go up more or it could go down. It depends on politicians and what they kind of decide. But the best thing you can do, regardless of what the allowance is to maximize it. Of course, we also need to be realistic, and it's not realistic to assume that every single year you have 20,000 pounds lying around that you can just put in your ISA. It's really important to do things within your own means. So after you've paid off your bills, your mortgage, etc., and then you've built yourself a safety net, whatever you have after that, just try to put it in the ISA. Maybe it's not realistic to hit 20K, of course not, if you can't, but try to use as much of the allowance as you possibly can within your own means. Now, something a lot of the ISA millionaires do is that they contribute early in the tax year so that their investments can start to grow sooner. So 6th of April, new tax year, boom, they put money in their ISA so they can start to work their money early on. And actually on Interactive Investor, 40% of their ISA millionaires basically used up their entire allowance by the end of April. So less than a month before the new tax year, half of them were using up the entire allowance. Getting in early so that their investments can grow sooner. Very simple example and illustration of how this works. So, annual contributions, picture 4 different investors, one person investing 5,000 a year, 10,000 a year, 15 and 20,000 a year, and assuming, a 7% average annual return over 30 years, what does the final portfolio value look like? And you can look at it over here. Needless to say, the person who is investing 5,000 a year only ends up with around $500,000 in 30 years time. Whereas the person who is investing 20,000 every single year ends up with a portfolio of around 2 million. So if you maximize your annual allowance as much as you can within your own means and get in early, you're doing something that a lot of the ISA millionaires are doing. Fifth is minimize costs. And there are 5 costs really to be aware of. First of all is platform charges. So this is the cost of using a particular ISA platform to hold and manage your ISA. So it's charged by the platform provider, the person who provides you with the ISA. Second of all, you've got fund and ETF expenses. So this is the total cost of owning a particular fund or an ETF. And then obviously you have trading fees, which are costs associated with buying and selling stocks, ETFs, funds, and etc. And it's really important to try to minimize your costs. So if you remember from our earlier discussion when I was talking about the power of compounding and exponential growth, this works both ways. So while compounding and exponential growth can make an initial investment grow exponentially, they can also make what seems like seemingly small costs explode when compounded over a very long time horizon. Again, just a simple illustration here. Let's say you have 2 investors, A and B. Investor A opts to use a platform provider that charges 0.5% a year and invests all of his or her money in a fund, let's say tracking global stocks, that charges 0.3% a year. So the total costs are 0.8% for this investor. Now picture another investor that goes for cheaper options, and the total costs of this investor is 0.3%. Now the assumptions I'm making here, just complete example, £20,000 in annual contributions over 30 years, and assuming that the fund they invested in generates an 8% average annual return before expenses. So investor A ends up with a net return of 7.2%, and investor B ends up with a return of 7.7%. I'm just taking that 8% and I'm subtracting their total costs. Now look at their final portfolio value in 30 years. Investor A, who went for the more expensive options, ends up with £200,000 less after 30 years. So what might seem like a very small difference, 0.5% a year, that's nothing, don't worry about it. Compounded over 30 years, it adds up to a huge amount, £200,000. Key takeaway here, minimize your costs. The platform that you choose, which funds and ETFs you choose, go for cheaper options, and obviously minimize trading and all the trading fees that come with excessive trading. Avoid that. Now, the sixth point is reinvesting income. So this chart, super powerful, and it shows you basically the S&P 500. So how an investment in the S&P 500 would have fared since 1980 to today, assuming the investor had not invested any dividends back into the index versus, and that's the yellow line, versus someone who reinvested all their dividends without paying any taxes on them, so the green line. And you can see the massive gap that you have over here. Again, this comes down to compounding. So dividends early on in your investing journey compound and become worth a lot after 20, 30, 40 years. Also, when you reinvest dividends, it allows you to buy more shares. So logically, the next year you get an even bigger dividend that you can buy more shares, reinvest, etc., etc. Now, what's really interesting here is comparing the green line and the yellow line. So the yellow line shows the final portfolio value had the investor invested in the S&P 500, reinvested the dividends, but after paying a 15% tax on their dividends. So every year they'd get the dividends, pay the tax man 15%, and then reinvest it. And they end up, again, a lot worse off versus someone who had reinvested dividends with no tax drag. And the reason I point this out is because in an ISA account, there is no tax drag from dividends, right? Every single pound of dividends you make, you can keep that and reinvest the whole amount back into the fund, the stock, or wherever you generated the income without owing the taxman anything. And that increases the benefit of reinvesting income. So this is especially appealing when done within an ISA because you have no dividend taxes to pay. So how do you reinvest income practically? So for stocks, a lot of ISA platform providers have an automatic dividend reinvestment service, sometimes called a DRIP or dividend reinvestment plan, which basically automatically takes dividends that you get from stocks and buys more stocks with them. So the same stock essentially. Turn that on if the service is available to you. For funds, usually when you look at different funds on these ISA providers, you usually have two units of funds, one that's called accumulation and one that's called income. Income funds, you just get the cash, whatever dividends and income these funds generate, you just get the cash landing in your account, whereas accumulation funds take any income generated, be it dividends or interest income from bonds, etc., and then reinvest it in the fund itself. So accumulation funds automatically reinvest income, and I would opt for that. Of course, this depends on your individual circumstances. If you have an ISA and you are currently in retirement and you need your ISA to generate income for you, this is not applicable. By all means, you should not be reinvesting income. If you need the income, take the cash and use it to fund yourself. However, if you're early on in your investment journey and you have no need for cash from your ISA, you should be really reinvesting income and benefiting from this compounding benefit. Now, the seventh and final point is to be disciplined and patient. Look, ISA millionaires were not made overnight. They were not made in 5 years. They were probably not made in 10 years. Investing is all about the long game. And if you want to be an ISA millionaire, it's the exact same principles. You got to be patient, you got to be disciplined. That's because the market comes with a lot of ups and downs. But when that happens, assuming you have a thoughtful, well-diversified portfolio, you just got to stick to it and stick with your game plan. And there's a very famous saying in the investment world that says, time in the market beats timing in the market. So basically, just having your investments in the market over the long run is much better than trying to constantly time the market. So trying to basically sell when you think there's a market top and try to buy back in when there's a market bottom. That never works. No one can do this. And I'll show you a really good example of this. Very interesting example. So this is from Morningstar, which is a company that has a lot of information on mutual funds, investment trusts, ETFs, etc. And they basically looked at many different fund categories. So over here on the left, you can see different fund categories. So international equity, bonds, US equities, etc., etc. And then the column that says total return shows the average annual return these funds generated over the past 10 years. And then the column that says investor return shows what investors in those funds actually generated. And you can see across every single fund category, investors ended up getting a lower return than had they just stuck with the fund and held it. That's because many of these investors were basically some of them trying to time it, some of them kind of reacting to fear or whatever, but they were buying and selling out of the funds, usually at very bad moments. So the market goes up, they buy a US equity fund because they're enticed by a rallying market. And then so they buy high, then the market crashes, they panic, they sell out of their funds, and then they sell low. And this adds up over time. So actually, the conclusion here from Morningstar is that investors missed out on about 1/5 of their fund investments average return. So they were way worse off by buying and selling the funds and trying to time things had they just kind of held the funds and not tried to do anything. This is what I mean by about time in the market beats timing in the market. So be disciplined, be patient, and think long term and stick to your game plan. And that's it. That's my final point. Let's see. Oh, wow, definitely ran over there. But I will, as promised, I will definitely stick around for at least 10 minutes of audience Q&A, which I'm going to pull over here. Okay. So first question, which stock and indices doing so well at the moment? Would you put the whole 20K into your ISA on the new tax year, or would you pound cost average? So going back to the thing I was saying about, having a well-diversified portfolio, I wouldn't necessarily put everything in one particular kind of stock market or index. I would try to spread that around several markets, several asset classes. And on the point on kind of starting early, if you had 20K to put in the new tax year, instead of kind of holding it and trying to buy incrementally through the year, if you want to really make your investments work for you sooner, you could allocate the most of that early on in the tax year. Again, assuming you have a long investment time horizon and you're going to be constantly adding into your ISA portfolio every single kind of tax year. Second question, what happens in terms of transferring the ISA to your family after your death? Is it tax-free? That's a really good question. I think based on my understanding is that your ISA is considered part of your estate, part of your taxable estate, so it will be liable to inheritance taxes when passed on to a family member. However, if you pass on an ISA account with a lot of unrealized capital gains, the same tax benefits that you have within the ISA account are applicable to the person who inherits it. So if they sell out of those investments because they're like, hey, I can't believe my grandfather bought this stock, I'm going to sell it, they're not liable for any capital gains tax, etc. Don't fully quote me on the inheritance tax. I believe when I was reading on that earlier, that is the case, but maybe just double check it yourself. But I think that's the case. What are your thoughts on investing in the S&P 500? Look, the S&P 500 is a very good representation of the US stock market, and the US stock market is the biggest stock market in the world by market capitalization. If you look at global world stock market indices, the US is usually 50% by weight. So I'd say the S&P 500 is a really good representation of what you would get by investing in global stocks, for example. It's a very good representation of the US stock market. And the US stock market has, historically performed really well relative to other kind of geographies. And now, obviously, you have all this excitement about the tech companies over there and the potential for AI, et cetera, et cetera. So I think it'll be hard to find anyone who will argue against investing in the S&P 500 again over the long run. So if you have a 30-year time horizon, S&P 500 would definitely be one of my core holdings. I try to add some other interesting stuff to that, let's say emerging markets, international stocks, bonds, etc., some of the other asset classes I touched on. But S&P 500 is definitely a core holding. The next question comes from Ricardo. From next year, we have several stock ISA spread between different Vanguard ISA, trading to 1 ISA, free trade ISA, correct. I'm not entirely sure what the question is, but yeah, you have different, Ricardo, all the names you provided are basically different platform providers of ISAs, so different companies providing ISAs. And yeah, you can choose you can go with whichever platform you want. But I think super important, and touching on that point I was discussing about costs. First of all, make sure you go with a reputable provider, read some reviews, et cetera. And then if you've narrowed it down to a few that you like, honestly, I'd really spend a good amount of time researching and making sure you fully understand the charges of using each provider. Not just the platform charge, look at what they charge you to buy or sell a stock. Some providers out there are still charging something like £12 every time you trade a stock, which I think is extortionate personally. So have a think about the trading fees, platform fees, what the fund selection that they offer, that's also super important. Do they offer a wide variety of funds, allowing you to gain exposure to different asset classes, or do they provide you with like a very limited number of funds and ETFs? All considerations when you look and compare different providers. We can spread between. About spreading, then more than one provider. If I understood you correct, follow-up, it's in the current tax year, one change that's happening is that you can top up different kinds of ISAs within the tax year, whereas previously you can only do it to one type of ISA. Okay, let me go and see what questions there are. Answer that. Any recommendations for flexible ISA providers? So just maybe high level, and a flexible ISA is basically ones that let you take money out within a tax year and put it back in without that money counting towards your annual allowance. In terms of recommendations for individual providers, I think because I don't really want to provide or say use this or avoid this, but I think really just kind of do your research. And I touched on a lot of the points in the previous question in terms of what to look for with certain providers. How do dividends work when you invest in a fund like the S&P 500? That's a really good question. The fund invested in the S&P 500 will constantly be generating dividends, because if you think about it, it's invested in 500 different companies. Many of these companies are paying dividends. For the investment fund itself, let's say it's an ETF tracking the S&P 500 or an investment fund, the fund itself will also be paying you dividends once a month, once a quarter, it depends. It will be aggregating all those dividends and paying it to its investors. Like I touched on the reinvestment income slide, usually when you go for a particular investment fund, you have an option to go with an accumulation or an income kind of unit. I'd really opt for an accumulation unit. If you buy an S&P 500 ETF, then you will get a dividend just like owning any individual stock. And in that scenario, you can activate the automatic dividend reinvesting. So whatever dividends you generate from the S&P 500 ETF will automatically be reinvested to buy additional shares in the S&P 500 ETF. Can you invest ISA as an limited company or only as an individual? Unfortunately, only as an individual. That's why it's called an individual savings account, and you can only do it as an individual, not as a company. Otherwise, I bet there'll be a lot of companies out there trying to rush and get some juicy tax benefits. I think I have time for one more question. So let me see what's next in terms of voted. I'm trying to decide between interactions. Okay. Is it better? So Alex is asking, is it better to invest in income generating funds or accumulated funds? So like I touched on kind of earlier, it depends. If you need the income, so if you're currently someone in retirement and you're using your ISA to basically help you generate income and fund your retirement, and then in that case, it's more sensible to invest in income funds. However, if your goal is capital growth and trying to maximize the value of your ISA, by the time you want it, then I really recommend accumulation units. These automatically invest income into the fund, and through the power of compounding and exponential growth, you're going to end up with a much higher amount in the future. I think I have definitely ran a bit over, but I appreciate many of you sticking around. Really hope this was useful and, learned something new. And yeah, apologies for going a little bit over, but like I said, hopefully was really informative. Thank you for joining me today. And yeah, I'll definitely see you at the next event. Thank you.